A company always has one of its main goals to generate a profit. Who owns the profit in a stock corporation? Right? The shareholders. Many companies decide to distribute part of the profit, not to be kept for further investments or reserves, in the form of dividends to the shareholders. German stock corporations do this primarily once a year, after it has been voted on at the general meeting. American stocks typically pay out once a quarter, some even monthly. As an investor, this is a super easy way to earn passive income. I just have to search for a stock on the computer, count how much share I want to buy, and voila, the stock is booked in the portfolio. Whenever there is a dividend from this company and I have shares in my portfolio, I receive a dividend deposited into my account. If a company can increase its profits over time, the amount of dividend payments usually increases as well, as seen in the example of my Allianz share position. But what happens now if a company's profits decrease, or if there is no profit left at the end, and it's no longer profitable? The management could, for example, decide to cut or suspend the dividend. For an investor who needs the income to supplement their retirement, or even wants to live off it much earlier, this would of course be less than ideal. Another downside could be that dividends have to be taxed. With companies that come from abroad, the topic can quickly become complicated and annoying, for example, in the area of withholding tax recovery. Individual stocks also carry a greater risk of market defects. Dividend stocks such as Shell, Chevron, or Total were in a tight spot a few months ago due to the sharp fall in oil prices. Now it looks different again, but depending on the industry, things can be very cyclical. All these problems can be solved by index funds. Index funds are widely known as ETFs, exchange-traded funds. These are cost-effective products that simply replicate an index by fit, without the management actively intervening in the selection of titles. Therefore, the fees are generally very low. Such a single index, but contains hundreds or even thousands of companies paying dividends naturally, also means diversification of distributions. I no longer have to rely on a single company to deliver, but instead get the average of many, many numbers. Due to the different payout days of the companies in the index, there are even ETFs that distribute not only quarterly, but also monthly. For someone looking for an easy-to-maintain passive income stream with moderate risk compared to the individual stock market, the Dividends ETF truly deserves consideration. Today, let's start by looking at how I would evaluate a typical dividend ETF and what criteria are important to me in the selection. After that, I've brought along a dividend portfolio that pays a dividend into the account every month. For all yield hunters who value a high payout and are willing to take on higher risk for it, I've brought along my best high dividend ETFs. And then finally, a factual look at the pros and cons of such investment strategies and these ETF products. As always, of course, no investment advice and just my personal opinion. Before we get started, feel free to drop me a subscription now to support my work for free. Turning on the bell to be notified immediately about my new videos is something I can also highly recommend. So, let's start with point number 1. What do I look for in a dividend ETF? For illustration, I've brought an absolute classic. We're looking at the Spider S&P 500 US Dividend Aristocrats ETF. This ETF includes over 100 companies. It's part of the S&P Composite 1500 index, with the highest dividend yield, whose dividends have increased for the last 20 consecutive years. The companies that are capable of increasing their amenities year after year demonstrate long-term quality through crises and are considered more defensive. Currently, over 4 billion euros are invested in the ETF. That's really quite substantial for a single ETF. So it's not a niche product, but a very large and well-known ETF. In general, I consider anything that is invested over 500 million euros to be solid and sufficient. With over 119 positions, diversification and risk spreading across different companies are also sufficient in my opinion. Sure, there are indexes with hundreds of companies, as we'll see later. However, because the companies in the index are high quality, in my opinion, that's enough. As the name suggests, the ETF focuses significantly on US companies, considering these companies are also global market leaders worldwide. It is not the case that one is only dependent on America for market trends. It is primarily about the location of the companies. Here you see the top 10 titles in the ETF. With IBM, ExxonMobil, 3M, or Walgreens, we also have well-known names, strategically placed in the residential and office property sector, realty income in the property rental sector, or Franklin Resources. In the financial aspect, we also have a nice diversification across different industries. The top 10 together account for about 18% of the index. That's a pretty high value. It would obviously be better to be at a maximum of 10 to 15%. So, no single title has a major impact on the overall rate. The ETF has a total expense ratio, also called TR, of 0.38%. It is automatically printed each year from the ETF investments. so it's not a classic wage that's formed from the account. Something under 0.5% per year is reasonable for ETFs. The general rule here is, the more niche and specialized an ETF, the higher the value. I would really only pay over 0.5% transaction fee if it were a very special. What I really like about the US Aristocrats Index is that it focuses on dividend payouts, but it has also historically provided very good price gains. This results not just in numbers through dividends. The companies in the index have seen a significant price increase over the past years. The dividend, which is distributed annually, could be significantly increased the year after expansion, simply because companies were able to generate more sales and profit. With the current number, you get a profit of 2.22%. This means for every 100 euros invested, you get 2.22 euros per year in interest. Of course, that the companies in the index continue to pay interest. This exchange-traded fund currently pays 4 times a year, namely in March, June, September, and December. That's pretty standard for a US index. This way, you can get an idea of how large the investments need to be in order to build a good side income. I have calculated this graph. These are all net figures per month. With investments of 100,000 euros, that's 203 euros per month in passive dividends that are saved into our account. With a 4 to 4.5% exposure and an investment of 500,000 euros, we already get 1,328 euros net in our account, and so on. So now we know what is important in the Dividend ETF. Top 10 holdings and a volume of over $500 million. Some might now say, why a whole portfolio or an exchange-traded fund that pays out every month? So that would be, yes, that's correct, they take a shot. But these are almost always relatively small, have very high costs, and are therefore a loss and an increased risk factor. The only thing I choose is a monthly payout instead of quarterly, and I also limit my choice. I have to take what I get in terms of costs, number of titles, and ETF size. Personally, I find it much better to buy just 3 ETFs, each in different neighborhood, more diversification, still low costs, and yet monthly cash inflows. And this is exactly the portfolio I've just presented to you. The first ETF in this trio is the Vanguard All Vault High Dividend Yield. This index refers to large and medium-sized companies worldwide with overwhelming profit loss, so industrialized and emerging markets are covered here. The ETF assets currently hold 2.6 billion euros in client funds. So here too, a very large ETF with significant market interest. The diversification across more than 1,768 positions is really enormous here. The ETF and the underlying index have a very broad approach and as many titles as some other MSCI awards. Diversification is very good here. It's clear that many top companies with a long history of dividends come from the USA. But countries such as Japan, the UK, Switzerland, or Canada are also heavily represented. Among the companies that are more heavily weighted in the index are pharmaceutical giants like Johnson & Johnson, Pfizer, Roche, apps like or also consumer goods titles like Nestle, Procter & Gamble, or Home Depot. In total, the top 10 only make up 13%, which I find acceptable. The total expense ratio is very decent at 0.29% per year. Nothing to complain about there. With a current yield of 3.3%, it outperforms the S&P Dividend Aristocrats Index, and despite its strong diversification, it's considered quite pure. The second ETF in the trio is the iShares Stocks Global Select Dividend 100. This ETF tracks the Stocks Global 1800 Index, which invests exclusively in companies whose dividend has not decreased in at least the past 5 years. Moreover, the dividend must be less than or equal to 60% of the earnings per share. It means that here too, there are more defensive and solid titles included. With nearly 2 billion euros in invested capital, this ETF is also a flagship product of iShares and not a small niche player. With 100 titles in the ETF, we don't have an overly large diversification, but it's still sufficient for me. But the country diversification here is even better, with just about 18% from dividend country USA. The rest comes from Australia, Japan, Hong Kong, France, and so on. So we have a strong focus on Asia included here. I like it as an addition, especially to the first ETF. The titles from the top 10 are thus mostly from the Asian region, with Shinji Solar from China, Xenaland as a real estate conglomerate from Hong Kong, or Mitsui, one of the world's largest shipping companies from Japan. Other titles are commodity giants like Fortescue or Ryu Tento. In total, the top 10 account for 20%, which for me is already at the upper limit of what I find acceptable for an ETF. In this depot, this ETF should only make up a third of the investment sum. So we'll have to see everything in perspective. The total expense ratio is at 0.46%, which isn't super cheap, but still within an acceptable range. The distribution yield is quite high this time at almost 4%. Given the current market weakness, I wouldn't be surprised if we go above 4%. As an addition to boost the overall return of the portfolio, this ETF is a suitable member of the trio. The third and last ETF in the trio is the Fidelity Global Quality Income. This index is relatively simple. The goal is to broadly participate in the development of global stocks with high dividend yields. This ETF has a total of 250 million euros in invested capital, making it by far the smallest in our trio. With over 236 titles, I believe there's sufficient diversification. Here too, there are overlaps with titles in the other two ETFs, but here the choice among the top 10 is somewhat different again. Here, for example, we have companies like Apple, Microsoft, or Nvidia included. So it's not just the traditional dividend-rich sectors like telecommunications, oil, gas, or raw materials included, but also a stronger focus on tech. With a 0.4% total exposure, so in the green zone, I think, the distribution yield of just under 3% is also decent, even considering that you have companies like Apple in the ETF. So, this is it. An ETF portfolio that provides sufficient diversification, has low annual fees, and includes mainly solid and more defensive dividend stocks in the process. The total portfolio costs amount to 0.38% per year, and the return at the tender is 0.38%. 3.36% is also worth a look. The portfolio distributes a dividend to shareholders every month consistently through the different payout quarters of the various ETF providers. It's also important to emphasize that these ETFs don't just deliver their average 3.3% dividend, but also experience price drops or sideways movement. With a more defensive approach, we have here a nice mix of returns through capital gains and returns through dividend payment. Of course, the past is no guarantee for the future, but the selection of titles itself is not only focused on high dividends. For those who are only interested in very high dividend payments and don't care about capital gains, wanting the total return to come from distributions, I've quickly brought along 3 exciting ETFs. The first ETF here is the iShares Asia Pacific Dividend ETF. As the name suggests, the underlying index represents strong dividend payers, primarily based in the Asia Pacific region. The ETF currently holds 334 million euros, so even though it's a bit more specific, it's still relatively large. With 50 titles, diversification here is suboptimal, I must say. With 50 titles, 3 or 4 titles that really tank can already have an impact on the overall performance. However, it must also be said that the criterion is highly divided. Solid companies and then based in the Asia-Pacific region, which really limits the choice of possible companies. We have here a mix of raw material companies, financial institutions, and with FeedTech, a manufacturer of phones. An Orient Overseas logistics player from Hong Kong has also come on board. The total expense ratio is considered expensive at 0.59%. That's also the problem with more niche ETFs, that the providers pick the more special title and also because customers are interested in such products and are actually willing to pay. The dividend yield is quite strong here at just below 6%, distributed 4 times a year, meaning quarterly. Another strong dividend ETF would be the FunEgg Morningstar Developed Markets Dividend Leaders ETF. This ETF tracks an index that primarily consists of large-cap companies from industrialized countries, which have demonstrated consistency and sustainability in dividend payments. Currently, the ETF contains around 160 million euros, so it's definitely a smaller niche player in the market. 99 titles in the portfolio sounds more precise at first level diversified for the rather very entrenched focus of the video. The top 10 are extremely concentrated, accounting for nearly 45% of the total allocation. As far as I think, all the titles are well known. ExxonMobil and Chevron as US oil giants, AbbVie as a pharmaceutical giant, Verizon and AT&T as telecommunications giants. With Butt and Philip Morris, the TER is at 0.38% in the green zone and considered medium priced. The distribution layer is also the same, especially since we have more defensive, well-known companies from the USA and Europe here. They have historically overcome all crises and have barely reduced or suspended dividends through the crises. And now comes an ETF with an insanely high dividend yield, obviously involving a higher risk, and also the question of how sustainable it is in the long term. This is about the iShares and Merchant Markets Dividend ETF. The index behind tracks companies from emerging markets that pay dividends and have been able to maintain a corresponding dividend payment program over a longer period. The titles must show a profit, has not decreased and has been paying dividends regularly for the past 3 years. The ETF currently contains 400 million. This is actually quite a sizable product for iShares, and also quite large considering that they are focusing on emerging markets. Also with high dividend yields. Currently, there are more than 113 different companies and stocks included, which I consider to be adequately diversified. The top 10 account for about 17%, which is not too little, but also not particularly critical. A few of us are probably familiar with the titles in this ETF. A lot of oil and gas, raw materials, energy, and primarily from emerging markets. Where top countries here are Brazil, China, Taiwan, followed by India, South Africa, and Malaysia. The costs amount to 0.65% per year, which I consider to be rather expensive. However, the selection of titles is very specific, and the product itself really appeals to a specific group of investors with its focus on very high payouts. Accordingly, iShares charges a good fee for that. The projected payout yield for 2022 is just under 7%. It is important to ensure that the ETF has been moving sideways for the last few years, and if not, so those were ETFs with a strong focus on dividend payments and distributions. Here displayed again with ISIN, stocks in the index, TER, distribution yield, distribution intervals. The S&P US Dividend Aristocrats is probably the most well-known from our list. I personally see the ETF as very defensive. Then we looked at my portfolio with monthly payout, a good kind of security, but also sustainable higher dividend payments on a monthly basis. And finally, we looked at 3 ETFs for investors who are purely looking at payout take on an increased risk. Let's move on to the last chapter now. What are actually the pros and cons of such dividend ETFs? Let's start with the advantages. For me, a very advantage is the emotional effect that results from a distribution. When I make a distribution monthly or quarterly, it's incredibly motivating to continue investing and see the amount increase. I can practically see my money working when it's invested. My MSc award, for example, is accumulating. I've invested a lot of money in it for my standards, but somehow I don't notice anything from it. The money is in there, and that's that. If in doubt, I might not even realize that investing is worthwhile because it's just not visible in front of my eyes how much this investment could actually yield in real life. If I were to invest the exact same capital in my monthly distributing portfolio, I would already get 4,600 euros gross per year. That would be 383 euros in dividends per month. After taxes and capital gains tax deductions, roughly 300 euros net every month. Emotionally, it's much easier to sit through a crash, and the monthly increasing payments would also keep motivating to invest money in the market when the stock prices drop. But another advantage is the easy handling of such a dividend ETF for investors who don't want to sell shares of an accumulating ETF later when they need the money. A payout is probably the simplest and most passive thing available in the capital market. Maybe I don't really care about price gains and just want money in my account every month to spend. For income investors, it's the ultimate all-in-one solution. Also, because an ETF is very simple to handle tax-wise, and I don't have to manually to reclaim, for example, if I buy only individual stocks. With hundreds of titles that such an index represents, an ETF naturally has a good level of diversification, but dividend-strong companies, such as Dividend Aristocrats, have historically had a certain it involves and brings in safety while still delivering a decent return. Where there are advantages, there are always downsides. One downside, for example, is that with a distributing idea of the year's taxes. In a dividend-rich ETF, where the main part of the yield comes from the distribution, a main part of the annual yield must be taxed directly. For accumulating products, I have to do the same, but the advanced lump sum that applies here is currently much lower. Another possible downside is the yield itself. Let's take a look at the S&P US Dividend Aristocrats, for example. You might say, only a 2.2% payout currently, that's almost nothing. I could, for example, buy the better Global X Super Dividend ETF. It historically distributes around 8% annually, sometimes even 10%. Why would I settle for 2.2%? At first glance, this might seem right, but at second glance, not so much. This is the price history of the S&P Dividend Aristocrats Index, once with dividends and once just the pure price gain. And for comparison, this is the price trend of the Global X Super Dividend ETF, which distributes 8 to 10% every year. Here, one has taken the dividend but suffered a significant loss on the price. In the end, you are worse off with such an ETF. If you're considering a high-yield dividend ETF with an over 4 to 5% return, ensure the companies in the index can at least cover the dividends. And the stock price moved sideways. It's naturally hard to predict, but the past can at least provide some clues. My conclusion is thus, always keep the formula in mind. The return on stocks is composed of 2 factors: dividends and capital gains. The higher it is, the lower the capital gain, or just the opposite should be irrelevant to me as a rational long-term investor. I always want to aim for the highest possible final return. So it doesn't help me if I get a few more distributions that are also absolutely higher, but still lag far behind the overall performance of an accumulating MSCI World Performance. Currently, it's actually the opposite. dividend-strong ETFs are performing better than the overall market. In the end, however, no one knows what the future holds. My appeal is simply, don't just blindly focus on dividends, but rationally look at the overall return that can be sustainably generated. In that sense, I'd be interested to know, do we have more dividend-focused investors here, or those who want to be such in their later retirement? Or rather, for accumulating ETF investors who wisely ignore dividends and don't need payouts? Thoughts? But feel free to write your opinion in the comments. In that sense, thank you for tuning in and see you next time.